All right, here we go. Hi, Steve Hodgson, Modern Asset Management, and this is April 22nd of 2020. We're in the middle of what is being called the pandemic, and I want to start with thanking everybody for being here. We got a nice little crowd, some names you recognize, some people I just talked to. I'm going to just take a quick high level just take a quick high level since I took 5 minutes to make a presentation, and it's I call this "Are you a buyer or a seller?" Then it's a look back, and then forget about this look back stuff and we start looking forward. So I pinched this from Dion's presentation yesterday, only because it's got the chart we've all been looking at. You know, so we see this same chart in everything. We see it in Corona, we see it in unemployment, we see it in anything we want to measure. We've got a chart, and then suddenly we have something that completely doesn't fit on the page. This talks about credit impairment, which for us bill collectors is past due. So, and these are broken down by credit score, and our borrowers, if we're landlords, our borrowers, if we're note holders, are on the bottom two pieces of this. And most of us are down here in the FICO 5 model, lower than 650. And I was in another meeting where the man who runs a company called Lending Point, which is the largest of the fintech unsecured lenders, I saw their delinquencies go from 6 to 12% in a couple of week period. And so this is just I guess my little point of view. 2007, it all collapsed because everybody was over encumbered. Us, the banks, you know, everybody. And so we hit this peak of debt service ratio, about 13, and then we've been deleveraging as a society ever since. Corporations are buying back stock and improving their balance sheets. All of us have, in total, less credit card debt. We're driving our cars longer. We're actually driving paid off cars. We've had equity improvements in our properties, and we've all got a little bit more cash in the bank. So as a country, as all one group, and nothing is one group, we're better situated for this battle than we were 10 years ago, right? So that's what I think is the good news of this. So we had all these other charts going one direction, and I thought this chart was important to say where we are on this scale. And so, we got a comment, Dion?
Yeah, it's interesting, right? So, relative to real estate, you know, one of the oldest benchmarks is the home price index, you know, Case-Shiller's dating back to late 1800s. In 2000, we pegged that to 100. In the crash, it never exceeded 200. And as of March, it was 214. And so, you know, some of the information that was out there, you know, you can contrast that with we were inflating the values of homes, likely because interest rates are still at an all-time high or all-time low in comparison to history, right? And wages weren't following. And so what kind of goes through your mind there when you look at that, you know, is it a misleader because are we better fiscally, or are there some policies in place that are making that look good? I guess, which is it's an interesting debate. We could probably talk about that for a while, but do we have a set of credit rates that are out there that are nice and pretty, and then what happens in delinquency and default? Credit card, unsecured debt, like as there's some delinquency and default rates. Even in the secured debt world, there's some delinquency and default rates. And what would be the severity? Do we have to lose income for that to grossly change? I don't know if there's an answer to that, but I just found that interesting.
So that slide showed that our personal debt was in better shape than it had been forever, but that was us making a dollar. If the whole country is taking a 20 or 25% cut in pay through either through straight unemployment or less hours or however that works, well, now that debt spikes right back up again.
Right.
Yeah.
Right.
So,
well, yeah, the percentage spikes. The debt's always been there, right?
Yeah.
Yeah.
Yeah. Yeah. And so we're pushing pretty hard to start a debt settlement initiative. I think I'm on the wrong side of. I think I'm making the wrong phone call if I'm calling borrowers today and asking them to catch up their late payments. Yeah. And so I think I should be talking to them about getting out from under at a discount. And so that's where we've been going. But we serve primarily the subprime market. Our book hasn't suffered as much as I thought. I immediately went into my sky is falling mode, and while I still think our payments may go down by half, they have not to date.
It's only one cycle, right? We're only talking 1 month.
One cycle, but I'm 85% plus, and I think I'm too. I think you're exactly right. I'm too early. Yeah. These are all people that were scheduled on automated payments. They haven't canceled them yet, and and where do we go? But here I am applying for a federal hardship loan, and I haven't suffered a hardship yet. Yeah. So.
Well,
yeah.
I'm not going to touch that.
Don't touch that. You want to hit a couple of high points from yesterday? I've got some. I got some tabs of things that I've come across lately. I just was going to run through.
Yeah. So those that don't know, we somehow stumbled our way into forming a distressed asset mastermind group. We've been talking every 2 weeks. Yesterday we had our second meeting. We've got a nice little array of folks in there that have real property experience, whole loan investing experience, some fund management, some private investors. It's a nice little mix of folks. And first coming out of the gate, it was kind of what is this and what are we going to do? Now we seem to be turning the corner and creating some real, at least starting to create some synergy within the group of how do we take on deals, how do we help people, how do we help you, and how do we help you help us? And I know that my phone has been pretty much so tattooed to my body over the last 4 or 5 days, and so it's been good. I think that there's starting to be some deal flow. I think that there's, as we're talking about right now, it's still a little early, but there's capital poised and ready. We glanced at, and whatever, got a slide from the Seeking Alpha article or whatever post that was talking about, a $1 billion+ raise in days took place for distressed assets. So we think, we see that happening. And it's tough it's tough, right? So I was just watching the TV box, and there's some optimism on there, but then I come back to my desk and I see something like that, and I'm saying, well, one of the adverse effects here can be that money drives prices down a little bit, maybe even a lot, right? So it's really a uncharted territory, but I think our group is going to do well, and there's a lot of folks who did this before. We're not the only ones, right? Obviously a lot of folks lived through this, but a lot of folks were in the space and navigated it, and and came out good, or at least learned from their mistakes. And I think this time around, some of the way that we did things before is going to be a bit different. We've talked about that. We've talked about targeting different types of assets. I'm not a huge fan of spending a lot of brain power capital on non-performing residential loans. We don't know what kind of protection they're going to get and how much longer things are going to take. And not to say there isn't an opportunity there, but just it's a lot of brain power. So we'd rather focus on some bigger projects and get out and certainly focus on some cash flow and making some opportunities as opposed to chasing some opportunities. And so I think more to come from that group, right? Is that kind of your takeaway from what's going on with us too?
Yeah, I think we found that we found that we still have the same orientation of I've where's my 20% return, but there's enough gray hair, enough people in that room that have that lived through the last one, and some of us have lived through more than one recession. That we understand that part of the job here is it's not return on capital, it's return of capital, and making sure that we're making sure that we don't gamble, that we're actually investing.
Right.
Yeah. So we talk about we're talking about ground up construction. We talk about lot splits. We're talking about redevelopment. While we have a negative bias against non-performing, that doesn't mean that's it's the world that I've lived in my whole life, is the non-performing world. And so with things priced right and with proper expectation, then that makes sense. That makes sense. Would I buy a pool? Would I buy a whole pool blind of non-performing seconds today? No. Would I buy non-performing seconds one by one if I understood the asset and the neighborhood and what am I going to do with this thing if I'm stuck with it? Well then, maybe.
One of the interesting things that I've had some conversations with some newer folks, at least newer to my circle, claiming to be sort of been around the space for a little while, is that there's certainly a lot of talk on the sidelines, waiting for the feeding frenzy to start. And in 2008 at the fund, we bought decent sized pool of assets, and we paid about 65% of the BPO value at that time. And that I just want to contrast that no matter where real estate values go, to some degree, there's a little, there's a footnote there, but to some degree, that percentage will always be the market percentage, right? So when we talk in terms of percent, we don't go from 65 to 45 just because values are sliding, right? Because if we're always marking it to today's current value, it's going to that equation that got us to 65 is going to be the equation that gets us right back to 65. And so I think when we come out of the gates and and maybe there is some more opportunities, price things right, be conservative where you're going to be conservative, but don't just nonchalantly discount something because something's going on. There's still there's still a metric to it. Whether Steve and I disagree on properties worth 100,000 or 90,000, certainly that's going to change the cash value of that bid. But we should still at least be agreeing that the bid is 65 cents or whatever it may be.
So I think let's, do you want to peek at a couple of your slides, or you want to jump into some of the other general topic stuff that I've got?
Yeah, I can post some stuff. What do you want to see?
All right. Let's see. I was just gonna share. You had talk about maybe take a minute. I was going to talk about capital stack, but that's too dense. Now we're in an econ class. Talk about the Georgia property a minute, just so that we have, I think that kind of orients us to what we can do as a group as opposed to one by one.
Okay. I'll also show the example of the register here, but so we're seeing deals. I'm seeing deals. Nothing. It's not a fire sale, but there's certainly some institutions, some private guys are looking to get rid of some stuff. There's some repositioning taking place. So we created a haves and wants kind of idea to simplify the conversation. Currently, I still happen to be the only one participating in that, but
I know a few things.
well, I guess I didn't put it in there yet. So, we know that there's been a crunch on Alt-A non-QM. So there's a little spike in some of those loans. And so if you don't know what that is, that's, non-banking loans, non-QMs and non-qualified mortgage. So that's going to include, private loans, hard money loans. And, you got to be careful that, when we use those terms, paint with a broad brush, just because hard money doesn't mean it was to rehab a house. But those types of loans are out there. The credit for those has had a little bit of a fickle. There's some, a lot of the inquiries that I've gotten, I think that you've got too, are some seller finance stuff that they need to get out of. The one that you were talking about is a decent example of that, where the mortgagee, it's a land contract. No, it's not. It is mortgage. He compiled it and ended up selling it to somebody that lived in the area. Took back a mortgage. The guy was going to finish it. Has 2 homes on it. It was supposed to be a 14-lot subdivision. Kind of put the land and the 2 homes back together. They were separated through when the bank took them back, and the bank kept the structures. The original developer had built an 11,000 square foot home. We're about 45 minutes south of Atlanta. He built an 11,000 square foot home, didn't finish it, put sewers in, didn't finish grading off, put a retention pond in. Streets were not put in. And then there was another home that was purchased to create a right of way into the subdivision. So, that smaller home would sell for about $160,000 once it was repaired. Bigger home in the subdivision would have a little bit better value, with the big home sitting on about 2.3 acres, and then the other 13 lots were right around 3/4 of an acre. So the client put those together and mortgaged them out for $260,000 at 12% interest only, and that developer, buyer, borrower missed his last payment and has missed the maturity. So the mortgagee is out of state, doesn't want to play with it. So we've been trying to use the group to kind of source some folks to chat with there. I have no desire to try to play with a development project in Atlanta, Georgia. But we called on some folks from the group to see if they had some contacts and, create a trade. There's definitely a discount there on the note. And so that's it's a good example of how we're trying to use the network a little bit more. I think a lot of times what folks expect is that, especially me, right? So I get a lot of pools, I share those pools, I trade those pools. I think we want to do a better job than just kind of brokering stuff. Not to say that things aren't going to get brokered, but do a better job of really assembling a qualified team to reduce, to mitigate some of the risk that might be involved in some of the assets. and some of that stuff you don't need to, right? And some of the stuff it's going to be pretty straightforward. But we've also got some some of the other development opportunities that we talked about where we're segmenting participation. So if you don't mind holding land or holding debt against land, we've got some pieces for you. If you want to hold a finished structure, or you want to hold it as a rental, create that kind of piece in that whole project. If you're willing to hold some paper, that was seller finance, whether it be a land contract for deed, or an actual mortgage or deed of trust, then there's a place for you in that project flow. So if we plug everybody into that project flow, then we can create a bigger project and everybody can win, right? That's kind of the theory. One of the interesting takeaways, and this was just on the news too. So I've got about I don't know, something like 600 student housing units in close to Indiana University, and they're off market. They're trading at a pretty aggressive cap rate. And the claim today, at least from what I saw, was that universities are one of the richest asset classes out there, and so they were starting to pick on them. And I would have thought that they would have saw a little bit of a decline, but in one of the asset packages, actually a guarantee for rent, and they're 80% leased up already. And so we're a couple months away from, in Indiana anyway, we're a couple months away from that registration being final, which I think is August. So I thought that was pretty interesting. They haven't seen a tick down, and parents and students are still doing stuff, and maybe there's that might have to do with some of the foreign exchange population and so on and so forth. But I thought that was pretty interesting that there wasn't much of a displacement in that lease up.
Right. They were still looking for a 5 cap.
Yeah, I'm working on that.
Yeah, but it's not a 10 cap.
No, yeah, right. Yeah, it's not a 10 cap. It's not a 5.
It's not today is not 2008.
Yeah.
Today's not 2008. It's not 2009. It is a national hysteria that we don't know. We don't know for sure. So this group that we've been trying to put together are people that are that have money to place, have deals that they need money for, have got things that looking for people that make sense. We're not trying to build a I don't know, a carnival. We're trying to So hit a couple of these. I want to go hit a couple of slides and then get people talking. Okay.
I don't know what else you want me to talk about.
Well, I can.
So we talked about I can show a little bit of the ICM stuff, or is that everybody?
Let's leave that. Let me go into some of the tabs. Let me go to some of the tabs I've got open, and that'll give everybody some things to talk about.
You got it. Let me stop my share.
All right. And so this is. Hang on. Sorry about that. Maybe get the right screen going. All right. So it's I've been a Bigger Pockets member for a long time. That's where I met Dion, and I'm a real fan of what they have. This is it's Facebook for real estate. So in that it can be full of all sorts of nonsense. I mean, there's me out there, people like me out there giving advice. You never want to take advice from me. But they do produce, they're producing this new BP Insights that they're grabbing some market data. They've got this guy Dave Myers writing these pieces, and he's a small multifamily investor in Denver, and I think he's also an economist. He's got some experience and some education, and so he went through and produced a market update where he was looking at at real estate rental inventory versus asking price, and he makes this long piece basically saying if you want to rent your place, drop the rent 5 or 10%, close the gap between the closes and the ask. The so it points toward a top of the rental market that maybe we're at this peak, that affordability becomes a real factor now that income is being depressed, and that trickles all the way through to cap rate and return and what's my yield and prices and all that. But he went and grabbed some data that I think he got from this site.
Oh yeah.
Which is House Canary. And House Canary basically aggregates all the MLS in the country and does some scrubs on it, and then produces interesting information. I've got this friend who is a large single family landlord in Southern California, and he's been selling properties. And so what a terrible time to try to clean out inventory. And he tells me today that while the MLS has got half the listings and half of the closings and all of that stuff that we're seeing in the news, he's got 7 houses in contract. And they're moving right along pretty much just like they normally would. And it comes back to the same basic rules. If it's a good property and it's priced right, it'll sell. And that applies to everything. If it's a good note on a good asset with good good equity coverage, it should sell and it should produce. And so I like House Canary. I like Bigger Pockets. There's and then on the other side of that, you go off to Yahoo Money, which the entire world sees. And this article, this is supposed to be news. It says housing expert, home sales could fall 30 to 40% in the next month. Right. So that's supposed to be a news story. It's not a news story. It's
speculation.
It's speculation.
It's a pull it out of your ass story.
Yeah, well, because it gets people to click on it.
Right.
And so what they put next to it is a Fox News box showing New York City being empty. We knew that, but there are some big things that are going to happen.
So I can comment on that, right? From the real estate agent side. What we did see, so I said we could see the same thing, but not next month, right? And she's got the word months, but nobody understands what that means. But we did see a 35% decline from February to March. Post day 0, which is March 13th, saw a 35% decline in listing value prices. So they didn't remain the same. Prices of listed homes did drop on a national average. And then a couple of the other tidbits that we pulled out, we shared. New housing starts are definitely down. They're down by about a quarter. However, existing home sales were up 6.5%, and pending year over year, and pending was up 2.4%. So I keep trying to find this slide. I'm going to find it. I'm going to show it once and for all. But I have these 2 amazing slides that when I saw these, they changed the way that I thought that I experienced the recession. And the most important one is the volume of transactions. This is from the National Association of Realtors. The volume of transactions from 2006 through like 2014 remained relatively the same. In my mind, there was a dip or there was some turmoil, and that's not true. They remain relatively the same. And the other slide was agents participating in the market remained relatively the same, because I thought people would have, if agents weren't making the same money, they would have left, and maybe there was vacation from the industry, but just as many people filled it. But they were relatively, standard lines. You didn't see a dip like I was expecting to see. And so what that tells me is, what we remember is that there was a value loss. And even though there was a value loss, and yeah, it's going to create some pain, there's still counterparty for that trade, right? And so the asset's still trading, so they were still getting absorbed. And if you revert back to the lack of new construction starts, because of all this, we're going to have some built up demand. And one of the interesting things, so I did a mastermind with my brokerage today, and one of the interesting kind of concepts that's out there is I have a lot of agents that their potential sellers are saying, hey, do a CMA on my property and call me right before the price drops so I could sell it real quick, right? And so that's absurd, right? But tons of people. I mean, I had more than one agent saying, yeah, no, that's kind of the task at hand right now, and we're trying to figure out what to do with that. But the general expectation is that, yeah, I'm going to sell, but I don't want to sell right now, but I don't want to get caught on the way down. And then on the other side of the fence, you've got the buyers who are going, yeah, I want to buy, but if we're going to slide real quick, I don't want to buy right now. And so some of this, to feed into that, some of this bad media is going to make some, it's going to make some bad decisions happen in the marketplace. And, so it's going to be very hard to predict, this is the human herd, right? It's going to be very hard to predict how things really are going to respond, because it's not going to be normal. If every seller decides that they're going to start to sell when the pandemic's lifted, and then you got to think you've got, the foreclosure gates, the foreclosure sales opening back up, you do get a flood of inventory. Well, if the buyers stand on the sidelines because they don't think it's the right time to buy, then we're going to start to build up some level, some sale inventory. But at the same point in time, we're not building more homes to introduce to the inventory, which we're still making more babies, right? So some interesting pressures, back and forth are gonna emerge that I don't think we can really. There's certainly no good model out there to figure that out. You can't model the human market psyche.
Well, and there's houses. Houses are still getting built. There's there's a project. One of the people on the call is working on a project in Pensacola. We've got we still got our rentals down there, and we sold all the ones that were for sale. The neighborhood I live in, there's a townhouse complex that they're still out there working on. So we're in a lockdown, not supposed to be doing anything, but there's still electricians on site doing things, and those are $500,000 condos.
Well, we talk about the potential forever changes, or the way that this thing has changed the way that we're going to do things moving forward. And so, you and I, we've been working on this, net zero home project kind of thing. And I was with the guy last week, and Lennar and Polte have come to our town. And so when the big boys show up, that things are happening, right? And they're doing panelized construction. And so within 30 days, they've got fundamentally like 6 homes up already. Mm-hmm. And so, one of the byproducts here that when we kind of think about that is, housing starts are down by 25%, that uptick, or that, coming into the market of tomorrow, there could be strategies like, modulating construction or panelizing construction.
Yeah, this Pensacola house is a SIPS construction project.
Is it? Yeah.
Yeah, and it absolutely makes sense. Even if the materials cost more to get it done on site, to have it delivered on site, put together, cut the time to market in half. It's just there's no other way.
Yeah, we're talking 90 to 120 days, where here in the Midwest, previously it'd be 6 months, right? By the time you got all that done. Yeah. And so that you know, again, that's gonna create that'll create some interesting impacts. You know, that's a little disruptive, because if they can just turn a machine on and start spitting home components out of a factory, you know, maybe that doesn't last, which could be a good thing and also could be a bad thing, right? That, you know, but we can talk about that, the whole genre of that later. But it's definitely going to affect the way that we recover, and it's definitely going to have some influences, and it's going to be tough to model. Again, I guess my point here is it's going to be tough to model that, and I don't care if you're, you know, Bank of America, JP Morgan, or how much data you got. You know, this is still unprecedented stuff, and you know, the future's being carved.
So I got one more picture to share, and then I think I want to go to yeah, this one. It's the Housing Wire headline.
Oh yeah, I saw this today. Somebody
Right.
posted this. I got
So,
I got a kick out of it. I commented on it.
So, and it's another example of the headline not matching what the real story is.
Yeah.
It said, then they say, but there are a few catches. So so this fits the borrower who closed on their new home in February. The virus locked everybody down in March. Their payments due at the end of March, and they can't make their first payment. These are for first payment defaults, COVID-related only, newly underwritten to make sure that they're going to pay. You know, that there's stability. They'll go back to work, and Fannie and Freddie are buying them at a discount.
Yeah. So just to be clear, these are loans sitting on the warehouse line.
Yes.
Before they were delivered to any of the agencies. And if the agency doesn't buy these, then the originator has a responsibility to get rid of it. And we are the, you know, in not, you know, no, the street level investors aren't buying these because the discount isn't big enough, but we call that scratch and dent. And so scratch dent is maybe a 5% discount from balance.
That's right. That's what these are. Right.
Yeah. And so usually that's because there's a small defect and Fannie, Freddie, or Ginnie rejected it. In this case, that defect, because it sat on the line, is a delinquent payment. And so by guidelines, you can't sell it in. And so what they're coming out and saying is, hey, we're going to waive that guideline, right? Because you're freezing the line. So then once you leave assets on the line, so typically you have a 90-day or 6-month line, and you got to clear it. If you don't clear it, then your line goes into default. If your line goes into default, you can't make any more mortgages. I mean, that's just quickly out of business as an originator.
Right, and you're stuck holding the bag on all of these and not having the capital to keep it going.
Right. Yeah, because your line is expensive, and these are, you know, just the same reason that we, as you know, more street level investors or private investors, don't go buy, you know, newly originated, agency loans at 5% interest or 4% interest. The same reason why they can't keep that on their line. Their line is, their line's normal cost of funds, 8 to 10%, depending on who they are. It's the velocity of them being able to book a loan, get it off, and book a loan. They can use that money a couple times.
Right. So, but this was again the looking at things from the eyes of the consumer frontline investor. I read this and say, oh, they're just going to buy up all the delinquent paper. No, they're not. But it was that was the last of the I don't know whatever this nonsense of trying to publish headlines that get people to look.
Clickbait.
Yeah, clickbait. That's me. I bite on clickbait.
That's the term the kids all use today, Steve. It's popular. Clickbait.
So I think there's I think there's opportunity to have two sides of a trade where everybody gets what they need. It takes two people. It takes two people walking away mutually dissatisfied to make a good trade. So there's folks out there that want to be out of the note business. They're afraid. They don't think their borrower is stable enough. There's people that there's people like me that don't mind some delinquency. That maybe the discount moves 5 or 10%. Like you said, we're holding to is paper 65 cents? Well, back in 2000.
Where you're discounting balance there. Let's not confuse the crowds.
Right. Okay. Right. But I was collecting underwater seconds and treating them the same as credit cards.
Yeah. They were essentially.
Yeah. Yeah. Okay. We were just they were underwater seconds, and that was that. Those days may be coming. But the folks that are operating the levers of the economy, they're going to find another way to screw up, not the way it happened before.
Right.
Right. Yeah. So here's an example of how they're trying to not create another Lehman.
Yeah.
Right. Okay. Well, what happened to Lehman is Lehman got caught. Lehman got caught without enough cash, and they didn't get bailed out. So
well, the scary part of that is the estimate. It's estimated. So prior to the crash, we had a little bit better oversight on what was going on, and the agency market, the Fannie, Freddie, Ginnie Mae, which fundamentally, when we think of loans, we think that that's what covers it. And it's only about a third of the market. It's less than 40% of the market. So that means there's 2/3 of the market that's out there in private origination hands. And
Quicken Loans, Loan Depot. Right.
Right. And so they were doing private securitizations, so there's a lot of that same stuff is still taking place. But the bad part about that is we can't see it. And so in that, much of the 2007 crisis, we're kind of saying we should have seen this because of, we should have done a better job with Fannie and Freddie being government-sponsored entities, and it's their securities. We're right back at, hey, we can't see it because this is Goldman Sachs issuing a private bond placement or a private pool placement for its loans that it bought. That maybe they match Fannie Mae guidelines, maybe they don't. So there could be some interesting shuffle cups that take place back there, and some of that stuff will fall to the street. Everybody's always been surprised when I tell them that even non-performing loans and REOs have ended up in securities, which is still mind-boggling to me. But I understand how they did it, but just super risky. I just got to think of the guy who bought that bond. I wouldn't have a lot of confidence in that bond. That's for sure. But these guys have been doing stuff that we don't even know. We don't know what's behind the curtain. Once again, I guess the story there.
So we've managed to use up most of an hour again.
You always make it talk.
Yeah. So this is supposed to be 20 minutes ago. We were supposed to open the floor, but all you folks have done Zoom enough now that you can unmute yourself and jump in with questions or comments. So fire away.
I have a question. I think that it's safe to assume that many people are not going to be going back to their jobs, and they're going to be either finding new jobs or they're going to continue working from home, because there's going to be a lot of empty employee offices, okay, a lot of empty buildings. So, and I don't know all the, data points on this, but what are going to happen to those? What do you think are going to happen to those buildings? I mean, well, why is it so? Is it prohibitive to convert them to affordable housing? Or what I'm hearing, as far as Dion said, that, some of these larger builders come into Indiana, as you mentioned, within, 30 days, they've got, 6 or 7 homes, boom, boom, boom. I mean, is that a cheaper way to do it versus taking an existing structure and, a 100 20,000 foot Kmart or something like that and converting it to affordable housing. I don't know the intricacies of that and whether that would solve some of the housing issues.
So I'll add that up. So it's a great question. There's my slide from earlier today. On the right is the language from that Seeking Alpha. And so I just had to tell my brokers, because I was saying this on March 14th. So I had to make sure they knew that I wasn't just making stuff up, and that I really do have a crystal ball and can see some things. But to your point, you know, we get confused that we tend to think that residential and commercial are pretty close in terms of asset class, and they're really not, right? So, you know, residentially purposed real estate is residentially purposed real estate. It's designed, it's built for the purpose of dwelling.
Right.
When we talk about commercial real estate, it's not.
I see.
And so retrofitting commercial real estate to go back to, or to become residential is extremely expensive.
I see. Okay.
Yeah. And so and when I say extremely expensive, if you know, in the Midwest here, we sell residential real estate brand new at about $165 a foot.
Mm-hmm.
You could spend almost that much, if not, you know, almost 200 retrofitting a commercial property.
I see.
Yeah. And so it's very cost prohibitive. But to your point, I think we're going to see these dark spaces. You know, there's going to be less of a demand for office. You know, there's going to be a lot.
Dion's frozen, so if he can hear me, he'll come back.
Yeah. Yeah, he's frozen. I don't hear him.
Yeah, so he'll figure it out in a second. But it's the infrastructure isn't amenable to being reworked.
Right.
In California, if you're going to build any kind of multifamily, you've got to give 35% of it to affordable housing,
Mm-hmm.
and that drives your return to negative.
I see.
Because you can't.
Okay.
You just, if it costs you $200 to retrofit, here it's okay because, you know, a house is $1,000 a square foot.
I see. Okay.
So
So yeah, I was just wondering how that worked, because you're going to have a lot of empty buildings. I mean, how do you repurpose that if in fact it's prohibitive to convert them into residential? Well, what do you do?
And it will happen with a public-private partnership. You'll get a bond measure that will allow for affordable housing,
Mm-hmm.
and then people, hey, he's back. They'll get a bond measure that will allow to pay for the affordable housing. Then the developer will be able to do the project because they have something that they can sell. I've been on the plus minus of Section 8 for a long time. I ran a property management company in Palm Springs in the crash, and the Section 8 Section 8 people were not easy to deal with. The tenants were problematic, and so I got a dim view of it. But now, having done enough work in other venues, that had I known then what I know now, I would have run a much different Section 8 program and been happy. You know,
do you think that given the economic climate and the fact that many people are not going to be able to recoup the same kind of stream of income that they're used to, you're going to see more people in the Section 8 program?
You're going to have a waiting lists for vouchers exist in most of the country,
Mm-hmm.
And that will continue. And
I'm here.
Yeah, there you are. Yeah,
we've got a surplus of vouchers.
Yeah, right. That's right.
Yes.
Yeah, you've got a surplus of vouchers, and they need more product, and it's this if you, and again, it comes back to the thing that my friend said: if it's a good asset priced right, it'll sell. If it's a good house, you put the right Section 8 tenant, they'll take care of it.
Mm-hmm.
Because the voucher in California here, the voucher is gold. I've got a ticket to rent.
Right.
So people try to protect us.
Mm-hmm.
And we've de-incentivized building affordably, right? And it's certainly been a conversation I've been having with folks as of late. But the big builders are going to build what they want, and you're either going to be able to pay for it or you're not. And it didn't used to be that way. 15, 20 years ago, we would build a little bit with affordability more in mind. And I think, Steve and I share the same idea there, where, if you're going to build something, make it, there's a bell curve for income and affordability. Put that thing in the center or a little to the low side, right? You want to put product out there that more people can afford. You don't want to be, I don't want to be in the luxury business, right? Steve's got some more stories about that. And so it's sexy to build a castle, but there's more peasants than there are kings, so you got to make sure they have a place to live.
Mm-hmm.
Oh, absolutely right. And we're not Toll Brothers, we're not Pulte, we're who we are. But again, I think the answer is just, this is not the time to try to go it alone. So if I've got 50 and you've got 50 and the other somebody else has got 25 and somebody else got 25, well, now we've got 150. Let's go build something. Let's go buy 3 of something. Let's not go out and cowboy things anymore. And I've done that. I've cowboyed my way out of several $1 million.
So if I can piggyback that for you, I've dealt with a lot of, we both dealt with a lot of, sort of lower level assets, and I've certainly dealt with my fair share in the loan market, but I've also dealt with my fair share of investors who are dealing with low level assets. And so to your point, you're a newbie investor, you're only going to risk, maybe you're not new, maybe you're slightly experienced or whatever, but you're only going to risk whatever you're going to risk, and you don't have, millions of dollars, and it takes money to get into better quality assets, and better quality assets are safer.
Mm-hmm.
And so one of the things that I think, if we do turn around and we take a look, when clients come to me and they're being burned by an asset, it's usually a low level asset. It's usually sub $80,000 price tag. Oftentimes it's a sub 50. That's why I've often been a big, I'm not a big fan of second liens, because if you're buying it for 1 or 2% of balance, it can't be that valuable. You're not going to have a good time collecting. And so, one of the ways to eliminate that, and Jim's on here, he knows what Ohio looks like. He's been in some places where it's it's not great, but so you can go find an area where medium priced homes, 80 grand, and then you're good. But if you go too far left, you're going to start looking at cheaper homes. It's going to be tougher to recover, and that neighborhood's going to be tougher to recover. And so, looking at it from a team approach, you can get into a better asset, and that better asset's going to carry better recovery for it, and a better price tag in the future.
Mm-hmm.
Anybody else with a question or comment?
I might have missed it, but I was just curious about the Section 8 opportunity in your portfolio. I think we had talked that there was like an 80% occupancy, and that you were looking to kind of split it off,
Yeah. So my brokerage, Premier Region Real Estate, we have a property management arm called West Hill Property Management. We've got about 140 doors that are in Gary. They've been compiled over time. We are liquidating one of those portfolios, which is called American Rentals, and that particular portfolio has about 37 doors. Doesn't have about, has 37 doors in it, and those are I'll show you here a couple tidbits of info. So in that portfolio, it's about 86% Section 8.
Mhm.
The you know, they're scattered around around the city of Gary. So I'll show you the map, but I can share this to you if you want. So in the red background, what you have is opportunity zone. So those are low income census districts, and so any asset in there qualifies for the opportunity zone tax incentive. Obviously, the blue markers are the data, and then the strats on the pool. We run a very low very low vacancy. You know, fundamentally, these are all, you know, single family homes. There's not a lot of 2 to 4s left in Gary, kind of spoken for.
Dion, make
Yeah.
enlarge the screen, enlarge your font. You know, use the slider to magnify.
Like that.
There we go, so we can see.
Is that better?
Yeah.
Okay, so I can scroll down through. Yeah, we've got, you know, our unit mix in terms of square footage. You know, one of the nice things about the Gary Housing Authority is a three bedroom, two bath will pay about $1,200. And so you're getting into homes that are, you know, $50,000, $70,000. So, you know, you can make some nice returns out of that.
What are the taxes? I mean, I guess I could look this up myself, but
our taxes are pretty reasonable.
Okay.
Yeah, I mean, you know, our taxes are pretty reasonable, you know, compared to other states where, you know, we're not Florida, we're not California. You know, we get municipal revenue through property taxes and sales taxes, and they do a good job, and we're a pretty healthy state. So our property taxes are stay pretty healthy. I'll show you the income here. It's performed relatively well over the last 3 years. We've got a 5-year history, but gross rev's been up around 300,000, and you know, we've managed it through to, you know, 180 to 160. There's been some lagging deferred maintenance stuff that we've kind of toyed with to try to get ahead of, and so on and so forth. And such is the nature of the beast with this kind of aged inventory. So if you didn't see, a lot of this stuff is like late 1950s, early 1960s, and there was some educational components to, you know, how to create a better proactive maintenance schedule. And so I think, you know, I think we've done that, but, you know, it's cost some dollars over the time. And in the beginning, we were kind of getting nickel and diming ourselves. But you know, I think that opportunity is still there. A lot of you know, Gary is a city that's missing 120,000 residents, but it's being regentrified. But I think you know, what I've been, you know, browbeating Steve about is, yeah, it's, you know, don't get me wrong, this is good product, it's turnkey, you're ready to have it. You know, I also think that there's an opportunity to develop on those already entitled lots. And so we can grab those lots and put new up, and then you're going to diminish those maintenance costs, and so you're going to have a little bit of a safer, you know, somewhat turnkey return as well. So there's 2 ways to kind of play that game, right? But in Northwest Indiana, we're about 45 minutes outside of Chicago. We have a large transit system that's coming in, about $1.2 billion improvement to the train transit that's here. And so we just got a Hard Rock Casino, which is, you know, I haven't seen any construction updates since COVID, but it was supposed to be opening by the end of the year. And there's a lot of other catalytic improvements that are taking place. And so in my experience, you know, and, you know, I hate beating this horse, but, you know, I look at it and I say, this is that thing that everybody thought was on fire, that, you know, a couple of years from now, everybody's like, shoot, and it's that one too. You know, that's my viewpoint on it. That's why I harp on it, because I think it's a great opportunity. It takes some work, you know, Not every neighborhood's great. And it's not like you can just come in and, you know, we've got some concentrations, some of this stuff over here, not so great. They need to work on those areas. So there's some good places you want to be, some bad places that you don't want to be. So I don't think you just kind of go it alone. And that, again, we're back to, teaming up. You need some boots on the ground, even in the NPL space. You need some good boots on the ground. Can't tell you how much money we've lost to contractors and NPLs for, random one-offs in a city. You got to find an REO agent. They're going to turn on their buddy Bill, and Bill's going to overcharge you. And, you're managing stuff through pictures. And, we got good at it. But it's still difficult. You still got a higher risk of loss. At least, I think what we've learned is to create a centralized focus, put a solid team together, turn around to investors and say, hey, this is it. This is the product. We're not trying to be everything everywhere. We're trying to be something here. At the same point in time, we obviously have a pretty adept knowledge and skill set with real estate related assets. But in terms of creating an investment opportunity for investors, rather do something that we can cover and speak to mindfully and respectfully about the soup to nuts participants in that project.
Mm-hmm.
So
Do you have any other questions about this?
No, I was just curious to know where you stood, because I agree that something like this, just a few years ago, it was like Gary, Indiana was someplace you want. Just run for the hills, and now things are turning around, from what I understand. It's
but it's everywhere in the Rust Belt. There's big operators doing turnkey in Columbus and Cleveland and Memphis and Nashville. There's people pumping out houses, like crazy, slapping a tenant in them and selling the house off. Roof stock is built on this.
right.
So what I've learned is, I bought 33 notes in 12 states. I could have bought 33 notes in Indiana and had spared myself so much brain damage. But I didn't. So, the last piece I've got is I'm playing around with this. I just registered this domain and started to put up the site because I don't want to get in the broker business. I'm going to point all these phone calls to Dion, but I'm still trying to find a ethical, transparent platform for people to get a fair shake. I'm not trying to go be Condor or Colonial Capital or any of that. I'm just fiddling around with an idea that maybe there's a way for me to let people in with verified assets and help move them from person to person. If that's Dion and his team going through and vetting them, if it's me going out looking for them, it's I don't know. So
For California.
And I started plugging in what I wanted, and what do I want to buy? Maybe I want to buy stuff close to home. If I want to play in the non-performing space, maybe I want to get ready for buying things that I can control. I don't know.
Yeah.
What this website will do is it'll have a page that says California, Ohio, Gary, Pensacola, however it is I want to set it up.
Mm-hmm.
If I have inventory that matches it, and I'm still working on getting the developer to put the right attributes in. So the idea is that somebody comes in with a loan they want to sell, they answer all of Dion's questions on the form, and then Dion gets basically a lead and can take action from there. Trying to eliminate the phone calls where people say, I'm thinking about investing in notes, educate me. You know, that's not, I'm not qualified to teach how to be an investor. You know, so.
Yeah, there's enough cannon fodder, especially, you know, I haven't been as active on the bigger pockets boards as I once was. there's talking heads and information that's out there, and everybody, look, you know, every investor is always going to be entitled to their opinion, you know, not that mine should. But as the independent loan investor emerged, there was a greater disparity between execution on bids or execution on assets. And in my opinion of the marketplace, and Steve and I would constantly sort of talk about this, is that disparity caused investors to go into assets that they probably shouldn't have and ended up overpaying for assets that they shouldn't have. And instead of paying the right price for the right asset, and you know, it's an interesting thing. We're kind of back to that same point where, you know, a good asset gets a good price, and there was always this notion coming out of the recession that, you know, loans are this discounted thing. And you know, I mean, I've had so many people tell me that, you know, here's an non-performing note, and they're like 50 cents, and I'm like, that's not the price. It's not. You know, I don't know who told you 50 cents is like a static price, but that's not how this works. So, you know, one of the things to do on any sales platform, because when I originally designed SDXS, we built software to try to do this. And, you know, we would take the loan pools in, I'd price them all out, I'd pass them out. And a lot of people don't know this story, but before the Granite Trade Desk, which if you guys have been around for a minute, before the Granite Trade Desk ever opened up, I was on the phone with Jeff Merrick and Chaz before Chaz became the portfolio manager there. And we were running through our SDXS software to help them use that as software. We just wanted to sell the software to them, and I just wanted to get out of loan trading. But that wasn't beneficial for them, that level playing field where I was saying, load a set of assets in, run it through this model. People are still going to tweak it. Steve's going to still want to do, you know, I think it's going to take 16 months, not 18 months, or, you know, vice versa. There's still going to be variances, but if you level the playing field to at least get people into being able to tweak what they, you know, what their conservative concerns or their aggressive concerns in an asset, then you're going to get a little bit fair of a marketplace. And the other thing that I wanted to do was share pricing, which is unheard of. You know, Fannie Mae will publish some stuff, but it's not at a loan level. But I wanted to start sharing prices, much like you do in the real estate space. So those are all things that, you know, that still aren't present in the market, and those are all reasons people still get burned up. You know.
Well, and to that point, so the loan that Bettina, the loan that I sold, that Deanna and I sold to you, that was, I think it was like 93 cents on the dollar of the unpaid principal balance. And by what we all hear in places, you know, I overcharged you grossly for that. What happened to that loan?
That loan worked out. I know. Here's how I look at it. Okay, I was a newbie. I was grateful that you walked me through the process. I learned a great deal from you and Dion, and I still do. And there's a premium for learning. And the way I looked at it is the loan performed. I think there was one payment she skipped during Christmas, and I found out, and I think you told me that sometimes these borrowers skip their Christmas payment because buying Christmas presents are more important than paying their mortgage. Okay, I got that, but she, you know, caught up. And then, you know, she was continuing to pay, and then there were a couple of months in which she maybe was late, but that she caught up. And then there was 1 month, and then I realized there was no payment, and I found out she was selling her home, and she didn't notify the servicer. And so I called up Madison Management. We had to hunt down the attorney who was, you know, dealing with the transaction. Anyway, one thing led to another, but she sold it, and, you know, I got the cash and that was due, and I'm just glad for the borrower. Here's how I look at it. This lady had a bankruptcy years ago, right? Then she had a modified loan, and the home appreciated where she walked away with a decent amount of cash, and that's recovery. So
Bettina, let me ask you. Let me just ask you a couple of things there. Why did you have to chase somebody down because the borrower was selling their home?
Well,
you don't have to do that.
The servicer didn't realize.
It's not their obligation to.
Pardon me?
It's not their obligation to. There's no way they could monitor the MLS or Zillow or any of that, right?
Right, but I wasn't getting my payment, and they reached out to the borrower, and the borrower said, "Oh, I'm selling my home." Okay, yeah. And so there was some confusion and once they found out that the borrower was selling the home, they failed to issue the
payoff.
The payoff.
Yeah. Well, you can't. Yeah. Okay. So, okay. But I guess my point was, again, so like as a mortgagee, they missed a payment. Hey, what's going on, servicer? Realistic expectation of a servicer. Borrowers miss. Borrowers go delinquent. Not unusual. They reach out and borrower says, "Hey, I'm going to sell my home." The servicer should be saying that doesn't absolve you from your mortgage payment. But at the same point in time, when they kind of say, "Hey, you're going to sell your home," so I could list your home today in April and not sell it until August. So payoff today is of no consequence tomorrow. But at the end of the day, what happened for you was you bought a loan, a little, you bought a loan in what people, I guess, would consider a high amount on the unpaid balance, but you had a lot of equity protection, if I remember correctly.
Oh yeah, it was tremendous. I agree. It was a $25,000 loan or somewhere around there.
Yeah.
And the house just kept on appreciating, and she sold it for $125.
So you won, she won, and that's so that's a good loan investment, right? Yes. So you don't want to. What you don't want is a loan investment where you're past the point of recovery and you got to start throwing money at it. You want to the point of making a loan is to get your money back.
Right. And the way I look at it is that it was my first loan. I was learning about the space. And I mean, it was, from that perspective, it was a good investment.
How many other loans have you invested in since that one?
Okay, so I have been doing more notes that I wouldn't say originate, but rather that I create with my borrower to finance fix and flips.
So you are lending?
Yes.
To a contractor that's doing some work?
Yes, actually, I have a model where I loan to companies have large portfolios of affordable housing in boring markets. So, and they go into neighborhoods, like neglected neighborhoods. They turn the neighborhood around. They renovate the homes. They stick in either market renters or Section 8, and then I get paid every month from the loan that I give them, and then it's collateralized.
Sure.
And then when that loan is due, the money either comes back or.
So you're doing short-term loans during rehab, which are risky. But if it's short-term, that means they've got to take out. So they're either selling it or they're refinancing it because it's stabilized.
Right, and I make sure that there's plenty of equity. Yeah. I mean, so that if the world blows up, there's enough equity in the house. And they're clear, I don't want their house. And I just told them, just all I want is my payment. I don't want your house back. And they don't want to give the house to the lender because it's profitable for them to, based on the amount of money that they bought the property for, to sit there and collect a nice Section 8 tenant rent.
Can we ask what kind of an interest rate you're capturing on those kinds of situations? What kind of interest rate in LTV? If you don't want to answer that, you don't have to.
No, of course, I would be delighted. I mean, all right. So right now I have about 25 loans out there with a number of different borrowers in similar kinds of business model situations. And I would say, you know, I have 9%, 10%. There are still some at 12%. I recognize that that is totally unreasonable right now.
Why?
Okay.
Whoa, why?
Well, okay, because they can, these companies have matured to a point where now they can go get conventional financing. They don't need me anymore. So, but what I'm saying is that there are several of them now that have come to me and said, look, we have a fund now and we've got to reduce the rate. And, you know, they're in their mind, they're overpaying when it's 12%. And so now that they've stabilized and so forth, they're well capitalized, they've got money and so forth. So they can afford to come down because there's more and more investors that want safety. So, okay. So now they're moving into this fund where
they got better leverage than you. Their leverage is cheaper.
The rate is a little bit lower.
Yeah.
I still get the depreciation because I mean, it's great being a private lender and sitting back and getting mailbox money. It's not so fun when you get your tax return because you're paying taxes on ordinary income.
Yeah.
So I also do some alternative lending with it's a company I found in Beta. They do they do private credit where I finance bridge loans, short-term bridge loans for like Amazon merchants. And that's worked out really well.
Property kind of stuff. Yeah.
That's worked out well. So I've diversified my lending into other areas, not just real estate.
So I would tell you, that rate of return is sort of market, right? And one of the things we're not talking about there. So look, when you're doing from an origination standpoint, I've done tons of these. Your biggest trick is you're gonna buy a piece of property that then needs to be slightly dismantled to some degree and put back together. So as is value is here, you're gonna take it down to here, and then in theory, you're gonna get it back up and everything's safe. And the industry, I can't pinpoint when the street came up with the acronym ARV, but I swear to you, it's like within the last 6 years. Like ARV has not been a thing that anybody has ever used prior to this. So values, value. I think everybody learned something from Enron about future value, right. And then they just put an A and an R on it, and so there's some risk in those loans. So if you're capturing, this is a little bit, we had a guy on that was talking about some of the loans that he makes, and he does similar, low LTV loans, so there's a lot of equity. Obviously, the risk in that loan is that when I start with 35% equity today, and you dismantle that property, am I maintaining that 35%, or am I losing that? And that's where a lot of people get burned. And that's where you get burned in the downturn, right? So I bought about 250 homes in Southwest Florida, where that exact thing took place, where they were doing construction, and it was a bizarro, like Stephen King kind of movie. Like you could walk through these subdivisions, and I swear I would expect somebody to be swinging a hammer, and they're just gone. And you just walk up and nails still sitting there, kind of mid-construction kind of stuff. And in that portion of Florida, these would have been $250,000 a door. And we were buying them for $48,000 a door.
Wow.
So lender didn't get out whole at all, right?
Right.
And so that's obviously that's the risk in those types of opportunities. But I think that's good. What kind of LTV do you get and do you charge them any points?
No, and I guess that And that's all part of my learning that
Yeah.
people ask me, why aren't you charging points? Well, I'll tell you, they pay on time, and I don't have an issue at all. The only concern I have is that it's interest only for the past few years, and when I get that capital back, it doesn't buy what it used to buy. And so now it makes more sense to go and take a look at what kind of amortized loans I can get, so that at least I get my capital back sooner.
Well, and so I think it flows from that portion of the loan universe into buying existing originations. But you have to be careful, and there's so many talking heads out in the marketplace. And like you said, people are like, why aren't you getting points? The more egregious you become as an investor, the higher on the risk scale you're naturally going.
For sure.
Right? You're not a better investor if you got 20% without recognizing you got into a riskier asset.
Correct.
Right? And so if I'm a good operator, just like your point, they've got a better credit facility because they've proven that they're a good operator. They've taken it to an institutional counterparty, and they're going to afford them probably 6-7% interest. And that's a going rate out there.
Yeah.
And you got to appreciate that. And so I think when the barstool banter pops up, and people are like, man, you need to be getting like 15-18%. You're get a lot of money for your money. You have to be careful that that you're not driving yourself into a riskier position. You're not driving yourself into a riskier asset, or you're not driving yourself into a risky situation with your counterparty. Because the guy who can't get money will take money at any cost, right? And that's pretty scary.
I felt that there was some risk mitigated because I was not lending to one fix and flipper, and it was not dependent upon one piece of property. I felt that because they have a portfolio of properties in boring, affordable areas, that if one is not paying rent, they've got 400 others that are, that my probability of getting paid was higher. And so, because the risk was mitigated in that regard. And so they were doing a really good job, and I felt, I wasn't going to charge them points because I was happy with their work, and that's the way
Well, both sides have to win, right? Did you ever contemplate cross-collateralizing the loan across their other assets, or did you just look at the other assets and say they can dip into that bag in the event of delinquency or default?
The way we did it is that we chose specific assets within the portfolio to tie my loan to.
Oh, okay. So they weren't. Okay. So existing performing assets, or existing assets that were leased up that you.
Yes, correct.
Oh, okay. All right. So you didn't have the risk. So they were using your money to do the project, but you were secured by a stabilized asset.
That's right. I had collateral. I had, property that was rented.
I got 37 of them. I can show you in a spreadsheet if you got a second on the screen.
Okay. Well, you see, but I that seems to work for me. And the only issue I have is that, like I said, that you get the capital back, and because of inflation and everything else, now it doesn't buy me what it used to. So
But I think and it's great. I'm glad that you're at that point, and maybe that realizations come full circle. And Steve and I have spent a long time, talking to our screens and typing into stuff, hoping that people come to that realization. The point of investing in loans is to recover the amounts that are due, and make some interest. And again, it's got to work for everybody. Just like you wouldn't go out as a borrower in today's climate and go to the bank of ABC Bank and take on a 9% interest rate when Bank of America is going to give you 4%, and everything else is the same. So there's got to be compensating factors on why you're going to as a borrower, take on that money, right? It can't just be because I think my money's more expensive. And I think one of the other things that I wish more, newbie loan investors would understand is how to better build a portfolio. So now, you know, in my recommendations, and Steve's been saying the same thing, go out and figure that cash flowing, performing baseline out. You create that baseline. So you've done it. You can go, you found some people, you can go earn your 8, 9, 10%, whatever you're earning, and you can sleep well at night.
Right.
And if you want to add some boost, then if you've got $100 that you're playing with, then take 20 and then go get a non-performer and let that be the boost to your portfolio. Or, you know, or take 20 and go get a piece of real property so you can, you know, get some tax benefits. But start to diversify your property in that manner where you level up into risk, whereas opposed to the street seems to start at the riskiest thing and then they come down. I have some ideas. You know, obviously I was a portfolio manager for a fixed income broker dealer. I've managed some pretty extensive portfolios, and I enjoy that. That's the way my brain thinks, right? So I enjoy looking at it and give you some of that opinion on, you know, what I think you can do, and if it's valuable to you, you can follow it. If it's not, and you know, I got my kicks, I guess.
Yeah.
Well,
Right.
okay.
All right. Well, that's a good spot to call it quits. I got